Hello guys, we're going to go ahead and check out chapter 14 today, the basic tools of finance. So remember the picture that I drew you guys last chapter. There's these people, which I call them the savers, right? Okay, savers. So remember the way we define savings in economics is taking money and at the end of the day that's left over that you haven't consumed. So income that you haven't consumed, right? And then on this side we have investors. I'll draw a little factory. And remember the definition of to invest is to purchase physical capital, okay? And so the savers are generally households that have extra income at the end of the day. This also can be the government if the government is running a budget surplus, right? And they somehow contribute to the investors. Now, investors are people who are going to buy physical capital. So generally, we think of those as firms that are going to purchase, I don't know, tractors or some sort of machinery. We can also think of those as people buying houses, right? Okay, because houses are little factories that produce housing. That's the way we think about it in economics. Okay, so they're going to send dollars to the investors, and they're going to get back a number of things, but somehow it's some sort of return on their money. Okay, we talked about if they directly talk to the investors, that's either going to be a stock or a bond, right? Okay, is the general way that you can talk directly to the investors. Or you can go through what's called a financial intermediary, a bank, or a mutual fund where you give them your money and then they purchase or they make loans to the investors. Okay, this whole thing right here, don't forget, is called the market for loanable funds. Exactly. And the way we think of that is we can analyze it with the traditional supply and demand model, right? And the very, very simple model that I had drawn, let me scoot this over a little bit, that I had drawn last class. Let me try to get a new eraser. That's being terrible. The very simple model that I drew last class was just, let's suppose that all suppliers of funds, the savers, all demanders of funds, the investors. Okay, so let me draw these over here so we remember who they are. Savers and investors. Right? They all contribute to this one marketplace, and they all take loans out from the same marketplace. We're going to continue kind of with that idea. Don't forget on this axis we have the quantity of funds. And on this axis we have the price of funds, which we think of as the interest rate. All right, so now that we remember what we learned in the last chapters, we're going to go ahead and think a little bit more about how this money goes from the savers to the investors and the kind of things that they think about when they're providing this money. Okay, so we're going to look into these questions. What is present value? We're going to use it to compare sums of money or a quantity of money in different time period. Now, why do we need to do that? Notice when the saver provides money to the investor, he's providing money perhaps in this year. They generally don't get paid back immediately, right? They get paid back at a future time, right? So exactly the same way that we were analyzing the unemployment rate, remember from 2014 to 1963, we have to compare them, the dollar values in the same period of time. We're going to have to do that here. We're going to have to compare somehow the money that they send to the investor. We're going to have to compare it to the money we get back and make sure it's a good enough return, and that will convince people to go ahead and provide money to the investors. And so we're going to develop this idea called present value. Okay? And we're also going to talk about risk. Because when you send the money to the investor, it's not necessarily true you're going to get the money back, right? If the investor goes out of business, you won't get your money back, right? So there's some risk involved, okay? And we're going to talk about how most people don't like risk. That's what risk averse means. And we'll talk about how people can get rid of some of their risk, okay? And then finally, we'll talk very briefly, and this is a very complicated topic, but it's kind of interesting, how to determine what the price of a stock or a bond should be. Okay, we're going to call that an asset. Something that the saver gives money to the investor and they get back a stock or a bond. Okay, we'll call that an asset because that's something that in the future can be exchanged for wealth. And we're going to try to determine the value of the asset. We'll talk about this thing called the efficient markets hypothesis, which helps us determine the value of an asset. And then we'll talk about why, given these two ideas together, it's impossible to like beat the stock market. Okay?
Someone like Warren Buffett be considered someone who beat the stock market?
Would Warren Buffett be considered someone who's beat the stock market?
As he's gotten higher.
He's gotten higher returns on average, and he's probably part of the reason of the efficient markets hypothesis. Basically, this says that no matter how smart you are, there's a smarter and better and faster investor who's going to get the return before you. So maybe Warren Buffett is the guy who is getting the return before everybody else, right? All right. So let's talk about an introduction. So the financial system is this thing in the middle. It's the general term for this thing in the middle that takes the money from the savers and puts it into the investors, right? We call that coordinating saving and investment. Okay. And so the people, both of these people, they come to the financial market, the financial system, to try to get some loanable funds or to try to provide some loanable funds, and they have to calculate risk. They have to calculate if it's worth it over when I compare the dollars that I'm giving up now to the dollars I'm going to get in the future, and then they go ahead and make the decision whether or not to allocate their goods. Okay? And in general, the part of economics, if you're interested in studying more about what we're talking about, it's called finance. Okay? Finance is the field of economics that studies this. Come on in. All right, any questions so far? So, let's get started. Okay, first I have to define some terms. I apologize, the board looks like it's getting really messy right now. Well, actually, let me draw our saver and investor back up here. We have a saver, we have the investor. Now, there are a couple of things that determine when a saver contributes some amount of money, let's say $100 to the investor, there's a couple of things that determine how much money the investor needs to provide back to the saver. Okay? One of them we talked about a couple of chapters ago, and it's called inflation, right? If in the future I know that goods are going to rise, the price of goods are going to rise, you need to pay me more in the future so I feel the same as today, right? So if there was inflation and the saver gave $100 to the investor and then all the prices went up 4%, well, at the very minimum, I would expect that when the investor gives the money back to the saver, it has also increased by 4%, right? Just so that this guy feels equal, right? He can buy the same amount of tacos at Del Taco next year as he could this year, right? So at the very minimum, we want to provide some sort of return for inflation. The other thing is that when I provide money to this investor, there is some amount of risk involved. I'm not sure if this investor is going to actually pay me back, right? If I'm providing money to the United States government and buying United States government bonds or securities, there's very little risk. I'm pretty sure this is called like the safe bet, or the most safest investment I could or savings I could make. The most safest place I could put my money is with the United States government. So there's very little risk. So it's likely that if I give them $100, I will get back $100 back because there's really no risk. But if, on the other hand, I'm financing some venture capital firm in Silicon Valley, and who knows, they might get acquired by Facebook next year, or they might flop, which a lot of these firms are like that. You might provide $100, and you might get $500 back or something like that because it's so risky, right? They have to somehow entice you, right? So we have talked a little bit about investment. We've talked inflation and why the return has to be bigger because of inflation. We've talked a little bit about risk. We'll talk about that more later in the chapter. But for right now, I want to have you guys assume there's no inflation. So this is going to make what I'm about to teach you easier. There's no inflation and there's no risk, okay? And even with no inflation and no risk, when the saver provides $100 to the investor, they still have to provide more than $100 back in the future. Why? It's because of this thing we call the time value of money. So if I were to take $10 and I say, I'll offer you $10 today, or you have to wait a year and I'll give you $10, what's everyone going to pick? Today, right? There's no advantage to waiting for the future because, well, I can just have the $10 right now, okay? So the idea is that we actually care about now more than in the future, not because we don't care about the future, but because the future's farther away. It's hard to think about the extra benefit of the $10 in the future. I can really think about how $10 can affect me right now. I can go to Del Taco and buy some more tacos, right? But it's hard to have the feeling of buying those tacos in the future. So there's this thing called time value of money. We discount the future. We don't care about the future quite as much as today, right? So if I were to give him $100 today, and he says, oh, I'm going to give you $100 back in the future, well, to me today, I'm making the decision today, that doesn't feel very good. $100 in the future is not as good as $100 now, right? So in order to entice me or encourage me to give him $100 today, the investor's got to give me $120 in the future or something like that, all right? So this is not inflation. This is not because of risk. This is just because of the time value of money, all right? So there are 3 reasons why the investors have to pay back more than the savers gave, okay? And we're going to just focus on the time value of money right now, okay? And so we have to develop this idea called present value. So when we're going to compare sums, and I hate this word, but I put it in this slide because this is what's in the book, so you guys need to know. Normally, the word sum means like the answer to an addition problem, right? Like 4 plus 4, the sum is 8, right? Or if you're adding up stuff. That's not what we're talking about here. We're just talking about a quantity of money. In English, this word sums can also be used to be a quantity of money, right? So if we're going to compare 2 quantities of money in different times, right? The quantity of money I'm giving to the investor and the quantity of money he's going to give back to me, that's 2 different times, right? Because it's going to be sometime in the future, we have to develop present value. Okay, so if you have the present value of a future quantity of money or a future sum of money is the amount that would be needed today to yield that future sum at interest rates, with the prevailing interest rate or whatever the interest rate is right now. So the idea is, if in the future the investor is going to pay me back $100, what does that feel like today? It's going to feel like less than $100, right? If the investor is going to pay me back $100 in the future, the present value of that $100 is less. If I know I'm going to get $100 in a year, that only feels like getting $80 right now. Okay, because I can't really picture the future. It's a long ways away. I can't really picture it. Yeah.
So that future value has nothing to do with the fact that inflation.
Very good question. This future value has nothing to do with inflation. It has nothing to do with the risk. Okay. This is a third. We are looking at present value. It has nothing to do with either of these. It has to do with the fact that psychologically, $100 in a year does not feel like $100 today, right? My happiness is greater if I get $100 today than if I have to wait a year to get $100, right? In fact, I can actually quantify the difference between those. If I offer you, let's say I had this easy to understand happiness meter, and I say, hey, I'm going to give you $100 in the future, and then I see how high it goes up on the happiness meter, and then I can tell you some amount right now. Okay, I'm going to give you $90 right now, or I'm going to give you $80 right now, and I look at the happiness meter, and I see where they're equal. That's what the present value means, okay? The amount of happiness that you get from $100 in the future, however much money if I gave you right now and that would give you the same amount of happiness, that's the present value of $100, okay? So the question is, what's the difference between present value and inflation? Is it the same thing? No, it's actually very different. So inflation, just means that prices are rising in the future because, why does prices always rise? The government prints too much money, right? Okay, so this just means the prices are going up in the future. This has nothing to do with my happiness. This just is a fact of the amount of dollar bills in circulation that the government has printed, right? Present value is the amount of happiness that I get in my heart from consuming something right now versus consuming it in the future. So this has to do with me, not the prices. The prices could stay the same the whole way, the whole time, right? Actually, for the purposes of this simple model, I'm assuming no inflation. That means I'm assuming the price of a taco at Del Taco today is the exact same as the price in the future. And even though they're the same prices, right, I still am happier eating Del Taco today than in the future because the future is far away and it's hard for me to feel it. Okay? Does that make sense? So that's why it's not talking about inflation. We're only talking about present value, right? I could add inflation on top of it, and if prices were going up also, then guess what? The money the investor has to give me back has to be even bigger. Okay? And you just add, if it's very easy actually to calculate for inflation. If the investor's paying back, say, 6% on the money and inflation is 3%, you just add that right on. 6 plus 3, and it's 9% that they need to pay back. Okay? All right, so that's the idea of what present value means. Now, this is very convenient in our market for loanable funds when we don't have inflation and we don't have risk. The only thing that's going on here is this present value idea, or the time value of money, which means that the interest rate in the market for loanable funds, if there's no inflation and there's no risk, any sort of interest rate tells you exactly how much less we value the future. All right? So if you have a market for loanable funds and there's not this and there's not this, then say there's a 7% interest rate on loans in the market for loanable funds. I know that people care about 1 year in the future. I know they care about it exactly 7% less than they do today. Because that's what happens. The equilibrium occurs at that point. All right? And I can put an actual number on the time value of money. Okay? And put it right here. All right, so I can put an exact number on the time value of money. So that's the idea of the present value of the future sum. Now we can flip that around, and there's this thing called the future value of the present money, right? And that just means it's the amount that you would have to give me in the future to be equal to how much I have today. Okay? Or the other way to think about it is, given the interest rate, if I put the money in the bank, it's going to be more in the future, in 1 year in the future, and that's the future value that's equal to this present value today. All right, so does that make sense? The future value is just the opposite of the present value. The future value is how much you'd have to give me in the future to feel like $100 today. That's the future value, okay? And the convenient thing is, in this simple model of the market for loanable funds where we don't have inflation and we don't have risk, the interest rate is exactly how much I feel like in the future that I need extra. All right? If the interest rate is 10%, then I can think of it two ways, right? One, in the future you have to give me 10% more than you do right now because I need that little extra boost so the future feels like as much as it is today. Or you can think of it, I could give you that $100 and you can give me back money in the future, or I could take it and I could put it in the bank and it'll earn 10% interest, and it's going to be $110 in the future. So if you're going to give me money back in the future, it's got to be at least $110. Okay? So that's the way to think about present value and future value. Okay? And we're going to use that because anytime I need to compare dollar values from two different time periods, and this happens all the time in economics, right? The individual who's loaning money to the investor loans it today but doesn't get it back for another year, right? You're comparing money in two different time periods. Or when we're trying to compare the the minimum wage today with the minimum wage 30 years ago, that's comparing dollar values across time. We always use the same technique. It's very simple. we just take all of those dollar values and put it in today's values. Always. That's just how we did it. If you remember back when we did the not unemployment rate, the minimum wage, we just moved all those monies, whatever the minimum wage was back then, we moved it into 2014 dollars. We're going to do the same thing for even future values, right? If I know I'm going to get paid some amount of money in the future, I'm going to move that back to how much it feels like today in the present, all right? And why do I do that? Because we always make the decisions in the present. Okay, so we always make decisions in the present. So anytime there's dollar values in a different time period, we always have to bring them back to today, okay, to the present. That's why we're going to use this present value idea. All right? So here's a very simple example, and we're going to think about deposits. So we are going to examine the thinking process of the savers when they contribute money to the market for loanable funds. We're going to look at their decision-making process of the savers right now. And then we'll do an example, and we'll look at the thinking process of the investors in a second. Okay? So let's say that I'm going to deposit $100 into the market for loanable funds or into the bank and get 5% interest. Right? What's the future value of this amount? Right? So if I put $100 in the bank today, that's going to be equal to how much in the future? Right? So it's not actually too hard. We just do this simple multiplication problem. We take $100, we multiply it times 100% plus we get 5% interest. So really it's worth 1.05 of what it used to be worth. So $100 times 1.05 is $105. Okay? And that's in just 1 year. Right? So in other words, $100 today gets me the same amount of happiness as $105 does in the future. You always have to give me a little more in the future because it's hard for me to feel the future, right? But at this point, they're equal. And that's what this interest rate is telling us. In the world with no inflation and no risk, it just tells me how much less I value the future. Exactly 5%. So you have to bump up my value by 5% in the future so I feel that it's equal. Okay? Now in 2 years, you just take 105 and you multiply it by 1 plus 0.5%. Another way to look at it is just 1 plus 0.05 squared, right? Because I'm just going 1 plus 0.05 times 1 plus 0.05, so I just square it. And I get $110.25. Okay? Now notice something here. This is a common mistake, so I want to point it out. A lot of times people look at this and go, oh, well, in 1 year it went up $5. So in 2 years, it should go up another $5, and so this should be 110. Right? If you the first time you ever look at this, you might think, right? Oh, it went up $5 in the first year, and now it goes up $5 in the second year. But that's not true. This is more. How did this go up the extra 25 cents?
Value of after 1 year with the 5% interest.
Exactly. It counts on the new value of the money. You get 5% interest on this new value, right? So really, this is kind of interesting, and it's handy in the term of the bank. You're getting interest on your interest, right? Because this $5 was the interest, the 5% interest that you got, right? Well, the next year, you get interest not only on your original $100, but you also get it on this extra $5. That's where this extra 25 cents is coming from, right? So each year, you get interest not only on your original amount of money, but you get interest on your interest, okay? And when we're thinking about the time value of money and how much you have to pay me in the future, we have to take that into account also, okay? All right, and then in 3 years, what's this formula going to look like? It's very simple. It's just $100 times 1 plus 0.05 to the third power. Okay. Again, it's just your original present value times 100% plus, this is just 5% written as a decimal to the third power because it's in 3 years. So you got 115.76. Right? So again, you see that it's not going up $5 each time because each additional year you get extra interest on top of the other interest you already got. Okay? That's called compounding. All right? When you get interest on top of other interest, or on the bummer side, if you have a loan and they're charging you interest on top of the other interest, right? Because for every person who's making a saver who's giving a loan, there's an investor who's taking a loan. You pay interest on top of your interest, or you make interest on top of your interest, called compounding.
And with simple interest, would that just go up 5?
Yeah, so simple interest would just go up 5% per time, right? But that's not how, one, that's not how the financial system works. Two, that's not how we work as human beings when we think about how much our money needs to be in the future, okay? In n years, so let's make it sort of general, right? So I can give you a general formula. In n years, you just take $100 times 1 plus 0.05 to the n. Okay? So why is this important? Again, because we're investigating the mind of the saver when he contributes money. So he contributes some money today, he gets back a certain number of dollars in n years. Okay? And the investor has to pay him at least this much money after 3 years, or else he's not going to take that. Right? Does that make sense? So if the saver gives the investor $100, and the investor says, yeah, I'll pay you back in 3 years, but I'm only going to pay you back $112. Well, the investor goes, or the saver, excuse me, says, no, I need at least $115.76 to feel like the $100 that I gave you now. Okay? So you're going to have to give me at least this much. And then, if there's inflation or risk on top of that, you're going to have to pay me even more. This is just in the world of how much I feel like I need to be compensated for the future, my time value of money. Okay? All right. So basically, I just want to develop the general formula, right? So you guys, I think you kind of understand where we're going. The future value is equal to the whatever the present value is, 1 plus the interest rate to the n power. So that gives us the ability to write a general formula. Since 100 is the present value, I'm going to write this formula. And I think you guys see where it comes from because I went through the steps of each year. And it's just very simple. The future value, how much is it worth in the future, or how much does it need to be worth in the future, is equal to my present value today, 1 plus the interest rate, r is the interest rate, to the n, which is the number of years. And this is a simpler version, the most simple version of this. This is when the interest is paid every year, and so it gets compounded every year, right? So anytime you look at a debt or any sort of loan, it generally tells you how often it's compounded, right? So if something is compounded every year, that means every year they re-add on the interest and they recalculate your new payment based on the interest you've gotten, right? Well, imagine if you compounded it every day, right? Every day you'd make the recalculation, and so you'd actually end up getting more money if you compounded it every day, right? Imagine if you compounded it every second or every split second, all right? Come on in. So imagine you compounded every second or every split second. That would be called continuous time compounding, and that would give you the biggest future value possible. And it's a different formula, but we won't deal with continuous time compounding in this class. I just want to make you guys aware of it in case you ever see there is another future value formula out there. Okay, it's got the letter e to it, you know, where e is the inverse of the natural log, and it looks slightly different. But the reason why is because that's in the world where we're imagining continuous time compounding. So they compound it every single second. But for the most of ease of calculation, we're just going to pretend that the bank compounds your interest once per year, pays you the interest once per year. Okay? All right. So this is my formula for future value. Now, perhaps I want to find the present value, right, from the same formulas. This is easy. I just get present value all by itself, which means I divide this side by 1 plus r to the n, and I divide this side by 1 plus r to the n. And so if I want to get just the present value, it's the same exact formula. I just reshuffled it around. Present value is equal to future value divided by 1 plus n to the r. Right? I just took this 1 plus n to the r and I divided it on both sides. All right? So these two formulas are very important because they relate some amount of money today with some amount of money in the future. But it's important to note that they depend on compounding every year, meaning the bank pays you your interest once per year at the end of every year. Right? If the bank pays you your interest more often or less often, these will be a little wrong. Okay? Okay, so here's my present value formula, right, the one we just solved for. Now I'm going to do another example. Instead of thinking about the saver who's saying, do I want to contribute my money to the investor, right? We examined and we saw that in order for the saver to contribute $100 today, the investor had to pay him back like $115.76 in 3 years, right, in order for it to be equal. Right? So this is the saver's decision. Anyone who says they're going to pay him back more than $115.76 in 3 years, he's good with, and he makes the loan. Now let's talk about the investor. When is he going to want to get a loan? Right? He's got to see if it's going to be worth it to him to get the loan because he knows that in the future he's going to have to pay back even more money than what the loan was, right? However much he got from the savers. So he's going to rely on this present value formula. And this is real simple analysis, but this is what real companies do every day. So let's suppose that the interest rate comes out to be 0.06, meaning people, the savers, value the future 6% less. So he knows that he's going to have to give them back 6% more per year. This interest rate is per year. So if I pull out the money for 3 years, right, I'm going to have to pay them back more than 6%, more than 12%, more than 18% actually. So here's another common mistake that a lot of people make. They're like, oh, the interest rate is 6% per year. Well, if I take the money out for 3 years, I have to pay them back 18%, which is not true. Anyone know why? Because of compounding, right? If I take it back, and if I take out a loan, in 1 year I have to pay them back 6%. If I take it in 2 years, I'm going to have to pay them back another additional 6% plus a little tiny bit of interest from that 6% from the first year. So maybe I actually have to pay them back 12.5% or something like that. If I take it out for 3 years, I have to pay back 6% for the first year, 6% for the second year, plus a little bit for the 6% from the first year, and then 6% for the third year, plus a little bit for the interest for the other 2 years that I didn't give them. Does that make sense? That's compounding. So you might end up having something that looks like, I don't know, 19% actually for 3 years, even though it's 6 times 3 is only 18. Does that make sense? Okay. So here's now we're going to go and we're going to put ourselves in the mind of the investors, right? You were thinking about that you were the saver. Now you're going to put yourself in the mind of the investor. The idea is, do I want to take this loan from the saver because I have to pay him back 6% per year? Okay? So here's his dollar values. He's like, should I spend $100 million to build a factory right now when I know the factory is going to be worth $200 million after 10 years? Okay? So here's the thought, right? I'm the investor. I'm over here. Do I want to build a factory that's $100 million, which means I need to take a loan for $100 million? Okay? That's what we're asking, right? General Motors doesn't have any money on its own. It has to get money loaned to it, right? Should I take this $100 million loan right now and build it into a factory? Because in the future, in 10 years, I'm going to have to pay this guy back, and I'm going to have to pay this guy back a serious amount of interest because it's 6% interest, right? I need to know if when my factory is worth $200 million in 10 years, then I sell that factory, if I'm even going to be able to pay back this loan, right? If I'm going to be able to pay back this loan and have some left over, then I want to do it because it's a profitable investment, right? But if and I sell this factory for $200 million in 10 years, it won't even cover that loan to pay back this guy, then I'm not going to make that decision and I won't even take the loan, All right? So here's the coordination problem, right? We investigated last example whether the savers would want to make the loan in the first place or save the money, give it to the investors. Now we're going to see if the investors even want the money in the first place. And it all depends on this interest rate, right? Because if the interest rate was 0, we would say, well, no, duh. You spend $100 million now, and in the future you sell for $200 million, you get to save all of that, you get to keep all that $100 million, right? But the fact of the matter is, time value of money, you've got to give the savers a little bit more per year back than you took from them. So we're going to make sure this is going to be enough, right? So how do we do that? We use this formula, okay? We say, what is the present value of 200 million in 10 years? Okay? So the way I think about it is this factory that's worth 200 million in 10 years, I'm going to move the money back to today's value. Remember, we always, any sort of dollar value that's in a different time period, we always move it in today's time period. Okay? Because I'm going to get 100 million from this guy today. Now I need to think about, well, is this 200 million that I'm going to make in the future going to be more than the 100 million I'm going to take from him when I move it into today's value? Okay? So it's really simple, right? I just plug this stuff in. The future value is $200 million. The interest rate is 6%. The number of years is 10. So I can do this right here. 200 million, 1.06 to the 10th power, right? 112 million. Yes. So this right here is not even thinking about the borrowing yet. This is thinking about how much is my hypothetical, theoretical $200 million factory in 10 years from now, right? How much would it be worth today to me? Meaning, I know I can get 200 million in the future, but that's way in the future. How much does it feel like today? It only feels like $112 million today, right? Okay, so I feel like I'm going to be able to get a factory that's worth $112 million. How much does it cost? How much do I need to borrow? $100 million. So should I take that loan? Yes, right? Should I take a $100 million loan today to get a factory that feels like today $112 million? Well, yeah, right? Because then I'm going to make, quote, $12 million. Really, I'll make nominally, or the dollar value, I'll actually make more. But once I adjust it for the time value of money, it feels like I made $12 million today. Okay? So anytime there's dollar values in other time periods, like this $200 million in the future, I always move it in today's values. Okay? I always move it into today's values. So the company, General Motors, says, oh, the factory feels like today $112 million. I move that $200 million in the future, put it into today's value, $112 million. Yes, it's worth it since I only have to take $100 million from this guy. Okay? So since the present value is greater than the cost, right? Present value, 112, greater than the cost, it should be built. Now, what does this decision-making process hinge upon? This, right? Interest rate. The time value of my money. If the interest rate goes up, I'm the investor, right? If the interest rate goes up, I might not want to do this loan anymore, right? Because the interest rate goes up. Does that make sense? When the interest rate goes up and you're the guy getting the money, that's a bad thing. When you're the guy giving the money, it's a good thing, right? But when you're getting the money, it's a bad thing. So let's imagine that the interest rate goes up to 9%. Okay? So the interest rate is 9%. Now the question is, everything else is the same. Everything else is the same. I get $100 million from the guy. I can sell the factory for $200 million in the future, but is it worth it now? Okay? So let's go ahead and just refine the present value. Let's move that $200 million into today's values. Okay? So I take 200 million divided by 1.09 to the 10th power, right? The only thing that changed here was this. Okay? And now I get that it's only worth to me 84 million. So what does that mean? Do I still want to take the loan? No, right? I have this factory that's worth $200 million for me in the future. When I bring it into today's value, it only feels like $84 million. Well, I need to get this loan of $100 million from the savers. I'm not going to do it. It's just not worth it. Okay? So the present value is less than the cost of the factory, and it should not be built. All right? So the only thing we changed here was the interest rate. And it seemed like actually not that much, right? It only changed from 6% to 9%. But it made a huge difference on the present value because it's so many years in the future, because it's 10 years in the future, right? When you start getting a number of years, that compounding starts to kick in, man, right? The compounding, and you get interest on top of your interest on top of your interest. And it really changes the problem a lot, okay? So there's the most simple decision-making process that I can make it from both the savers, do I want to contribute my money in the first place, and then to the investors, do I want to get my money, or do I want to get the money or take the loan? Okay? And this, I think, is kind of cool because it helps us understand why. Come on. This, I think, is kind of cool because it helps us understand why investment goes down when the interest rate goes up. Right? If I remember in the market for loanable funds, the demand curve goes down. Right? Which tells me if I have a low interest rate, I have a high Q of funds. But as my interest rate goes up, right, the quantity of funds demanded goes down. Right? We saw this with the demand curve last week when we were doing the market for loanable funds. As the interest rate goes up, the quantity goes down. This is what happened in this example. The interest rate went from 6% to 9%, and all of a sudden General Motors says, I'm not taking this loan anymore. Okay? That's an example of interest rate going up and then the quantity of loans going down. Okay? So it helps us understand, even though you knew that demand curves always have to slope down, it helps us understand why it makes sense for the demand curve to slope down in this particular market, the market for loanable funds, which is, to be honest, is very different than the market for hamburgers or something like that, right? There's a lot of different stuff going on, even though the curves look the exact same. Okay? So with this present value analysis, we can see interest rate goes up. I know how long I want to take the loan. Investment goes down. Okay? So the key, whenever you're comparing quantities or sums, like the book calls them, quantities from different time periods, bring them into today's time period, and then do the analysis. That is always the way that you're going to deal with this problem in all of economics. Okay? Now it's your turn to do a problem. Okay? I've been talking for long enough. So I'm going to give you an example in this thing called, I don't know if you guys have heard of it, it's called raw land. People do this. They go to the edge of a city and they buy raw land. No houses, just a chunk of dirt, right? And then why do they buy that chunk of land? What do they hope? It's at the edge of the city. They hope that the city will grow, then somebody will want to buy that land to build a house or a factory or something, right? This is really common. It's called raw land. It's pure speculation, meaning I'm purely hoping that the value goes up. I don't build any houses on it. I don't do anything. I just buy the land right around the city, and then I hope the city expands. Okay? Like most cities do get bigger. So it's kind of, a lot of people make a lot of money on this. Okay? But let's pretend that you're a raw land investor, right? Okay. You're going to buy this lot for $70,000, and then somehow you know that the city's going to be big and it is going to grow, and you're going to be able to sell it in 5 years for $100,000. Let's say somehow you know that, right? In real life, you don't actually know that. But let's pretend you do. The question is, should you buy the lot? Well, the thing that you always have to ask is, what's the interest rate? I can't find the present value without an interest rate, right? I need to change this. This dollar value is not in today's life, right? This is not in today's. I need to change this dollar value, which is how much I'm getting out of it, into today's money, and then I can compare it to the cost. So you're going to do that if the interest rate is 5%. Now you're going to want to do it if the interest rate is 10%. Okay? So go ahead and do that. You can talk to your friends. I'll give you a couple minutes. Whoops. All right. A. What did you guys get for A?
78,000.
78,000. So what is 78,000? I think that's right? What is 78,000? Yeah, 78,350. Is that what you guys got?
Yeah.
78,350? 352? I thought I did this on my calculator. I thought I could have written it a little wrong, but I think it was 350. I did not get 352. But okay. So what is 78,350? What is this? What's that telling me? What is that?
The present value of 70,000 in 5 years.
You're close. It's the present value not of this guy. It's the present value of this guy, right? Because you're buying the lot today. This is already in present value. It's $70,000 today, right? You get to sell the lot in the future for $100,000 in 5 years, right? But that's in 5 years. I have to move it back into today's value to how much does it feel like today? If you give me $100,000 in 5 years, how much does it feel like today because of this time preference of money thing? It only feels like $78,350 today, right? Well, I can buy the lot for $70,000 today. I get back some amount of money that feels like $78,350, right? So, yeah, I should get it. The present value of that $100,000 is more than whatever the cost is going to be. So I'm net going to be happier, right? I'm going to make money in the future. Because the interest rate is 5%. Meaning every year I value, assuming in this very simple model, right, that there's no inflation and no risk, the only thing inflation or the interest rate tells us is just how much less I value the future. It's because I value the future 5% less each year. Now, in real life, this interest rate is you have to incorporate inflation and risk, okay? But just for the simple model, I'm just showing you how to do it with the time value of money.
So if this
Present value of the lot is greater than the price of the lot, right? How much is the lot? $70,000. This is already in present value because I buy it today, $70,000 today. I get to sell it for $100,000 in 5 years, but that's not today's time. That I have to change into present value. Okay? Anytime there's money in different time periods, I always bring it to today. That's very important. Okay? So yeah, exactly. So the present value of the lot is $78,350. Greater than the price of the lot, $70,000. So we should buy it. But now I'm going to change the interest rate on us, right? Because that's what makes the difference between these problems. Let's make the interest rate be 10%, which means that I value the future 10% less each year. Okay? Should I buy it now? Well, once again, I still have to move that $100,000 into today's value to see if I want to buy it. So I use the formula. Present value equals future value divided by 1 plus r to the n. I get 62,000. Okay, 62,090. Which means that because every year I value the future at 10% less, that's what the interest rate is telling me, that means that even though you're giving me $100,000 in the future, it only feels like $62,090 to me today, right? And today I'm going to have to pay 70 grand for this lot, right? Today I'm going to have to pay 70 grand for this lot, so it's not worth it to me to make the purchase. So I should not buy it. The other way to think about it is, well, the interest rate's 10% right now. So I could take this $70,000 and put it in the bank and get 10% interest rate, and then I could pull it out in the end of 5 years, and I'll have more than 100 grand. I shouldn't buy this piece of property. I can just take the money and put it in the bank for the interest rate of 10%, right? This is the other way to think about it. And I can get more money than buying the lot, so I should not buy the lot, right? So once again, when the interest rate goes up, what happens to the amount of loans that I take out? They go down. That's what the demand curve in the market for loanable funds is telling me. Okay? Good question. So what is this R exactly telling us? What is that rate? Don't forget, in this very simple model, right, the savers loan the money directly to the investors. There are no middlemen, and there's no inflation and no risk. So the rate that the saver gets is the rate the investor pays. The R is the same for both of them, right? He's going to pay 5% interest on the money. This person's going to get 5% interest on the money because there's no middleman. This is just a really oversimplified version of things, right? Of course, no inflation and no risk. So in this situation, the reason why this guy's paying 5% interest or 10% interest on his money is simply because of the time value of money, the difference in the preference for my money now versus later. The only thing that's generating an interest rate that this guy has to pay is the fact that I like my money now more than in the future, right? How much less do I like it in the future, or how much more do I like it now? I like it more 5% now. Or I like the future 10% less. In this case, you're really going to have to give me a lot of money in the future because I don't really like the future that much, right? That's why nobody's willing to make loans. Because, man, you have to pay back those savers so much in the future because they just don't care about the future, right? Another way to think about this is when you have a high interest rate, people discount the future a lot. Like, they don't count the future. It's very important, okay? All right. So let's go back to this idea. Remember I taught you about compounding. It's actually quite cool. It's quite powerful it's quite wonderful if you're the saver, right? The compounding is quite terrible if you're the investor, okay? Or the guy taking the loan. Remember, compounding generally says that every time they pay me interest in the next year, they have to pay me interest not only on the money, but also on the extra interest that I got in that first year, right? So my money keeps growing and my interest keeps growing also, okay? So here's the idea. It means your quantity or your sum of money is going up because the interest you get every year is given to you on top of the additional interest that you already got in the previous years, right? So in the first year I get $5 interest. In the second year I get more than $5 interest because my bank account's growing because they already threw the interest in there, all right? So because of this compounding thing, even changing the interest rate just a little bit, if you let it go for enough time, it makes a big difference in the future value. Okay? Like, check this out. Let's say you bought $1,000 worth of Microsoft stock and you just held on to it for 30 years. Okay? This is a real popular strategy. It's called buy and hold. Okay? And it's especially normally done with big low-risk stocks that are kind of the way that people call them. There's this word in the investment circles called blue chip stocks. These kind of big, good performing stocks that are going to be around for 30 years. You can do the buy and hold strategy, right? They're called blue chip. If the company's not going to be around in 30 years, then the buy and hold strategy doesn't work, right? Okay. So I did some math for you real quick. Let's say that the interest rate was 8%, right? In the future, look, this is only $1,000 today. In 30 years, it's $10,000, right? That's a lot, right? A lot, because of compounding. But you know what even the cooler thing is? Let's just move that 8% up barely to 10%, right? You wouldn't think it makes that big of a difference, but look at this. It goes up to $17,000. It almost doubles the amount that you get in the future, okay? Because of compounding. And it's only, look, it only went up. The interest rate did not even close to double, right? The interest rate did not even close to double. But the future value almost did double, okay? It's this idea of compounding. Every year you get a little more interest, and then the interest you earn in the next year gets earned on the original money plus the interest you earned in the last year, okay? So the buy and hold strategy is actually quite powerful. This is the reason why everybody always says to put money into your retirement account and just leave it and then let it grow untouched for a lot of years, because this does happen. Question? Okay. And so remember that I said that the formula I gave you was only for compounding every year, meaning the bank puts the money in your account at the end of every year. In real life, a lot of times we sometimes think of continuous time compounding, meaning the interest gets immediately added to your account, and so it grows. I told you that was a complicated formula. I'll give you a trick, so you won't have to learn the complicated formula, but you can still know something about it. It's called the Rule of 70. This is very popular amongst investment advisors, which, by the way, is an improper name, right? They should not be called investment advisors. They should be called savings advisors, because you're the one doing the savings. The factories that you're buying stocks of are doing the investing, right? Because they're buying physical capital, right? So remember the difference. But here's the Rule of 70, so you don't have to learn the complicated formula. It's this. If the variable grows at X percent per year, it's going to double its value in 70 divided by X years. Okay? This is just a really simple trick, so you don't have to actually learn the other confusing future value formula. Okay? So check this out. Let's say the interest rate is 5%. 70 divided by 5 is about 14. So that tells me that if I put money in an account and I get 5% interest on it, in about 14 years it's going to double. In about 14 years it's going to double. Right? And this is just a trick to get around the fact that the other formula for continuous time compounding is kind of confusing. Okay? And then look at this. If you just raise it just a little tiny bit, from 5 to 7, right? 70 divided by 7 is now just 10. So if you just raise the interest rate slightly from 5% to 7%, you get the fact that it will double in value in not 14 years, but in 10 years, a lot quicker. All right? So you see that a small increase in the interest rate means a big increase in the rate of growth. Right? If you can get, and that's why when people try to get home loans, like they'll fight over 4.8% versus 4.7%. It seems so small, right? But home loans are for 30 years. It can mean like tens or hundreds of thousands of dollars in interest that you don't have to pay if you can get 4.7 versus 4.8. Right? It's a big difference. All right? So that's the Rule of 70. It's just a trick to be able to kind of use this in the real world with continuous time compounding and not have to know the tricky formula. Okay.
Why is 70 not any other number?
It just so happens it's the math. If I were to show you the big long formula, you'll see that it ends up being about 70 divided by x, and that's all it is. It just happens. Some people use 72 actually, 70 or 72, because it's just an approximation, right? The continuous time formula for compounding, if you want, look it up on Wikipedia. But you'll see that if you were to plug in a bunch of like testing numbers and test it out, you'll see it's about 70 divided by x. It's just a trick. That's all. Okay? Okay. We'll get started back again. Now we're going to introduce this idea of risk aversion. So the whole first part of this chapter, we had been imagining no inflation and no risk because we were just looking at the time value of money. Now I want to relax this risk assumption and talk about a very real issue that we have when we give money to the investors, is this idea of risk. And actually, we're going to think about how the financial system can actually get rid of risk. Okay? Because we're going to imagine that people don't like risk. That's not a bad assumption because it's true for most people. Some people that maybe are addicted to gambling, maybe they are what we call risk-loving personalities, but most people we're going to assume don't like risk, okay? And we call these people risk-averse, okay? So the average person is risk-averse. They don't like risk. This is not including those small number of people who love to go to the casinos and gamble away their money. They might be risk-loving, okay? But most people are risk-averse, meaning they don't like risk. Okay? And so here's an example. All right? Let's say that I say toss a fair coin. And I say fair just because I'm like, nobody did anything to this coin. This is just a regular quarter from your pocket. You toss the coin, right? If heads, you get $1,000. If tails, you lose $1,000. This is really risky. How many people are willing to actually play this? Probably nobody here, right? I mean, this is a really big bummer, right? Okay, so we have one person who would. Everybody else is saying no, right? Even though, right, the expected value of winning, right, the expected value of winning is you win $1,000 50% of the time, or you lose $1,000 50% of the time. So that exactly cancels out. And your expected value of winning is 0, meaning that you should be equally happy. If you were not afraid of risk, you would say, well, if I don't play it, I earn 0. If I do play it, on average, I earn 0. So it doesn't matter to me. Yeah, maybe I'll take it, maybe I won't take it, right? If you didn't care about risk at all, then you would be like, yeah, sure, I'll take that gamble, or maybe I won't take that gamble. I don't care. But the fact of the matter is, I don't think anybody here wants to have to deal with this, right? Flipping the tails, flipping the coin, getting tails, and losing $1,000, right? You probably are not going to take this gamble. This is an example of risk aversion, all right? And so one of the things that the savers are always trying to do is avoid risk, right? This is something that's always happening. This is basically what I said, right? The pain of losing $1,000 is worse than the happiness that you get from winning $1,000, right? So nobody ends up taking this gamble. I guarantee you if I were to offer it to all of you guys. And even if I made it even a little bit more sweeter, like if heads you win $2,000, if tails you lose $500, where like that's actually pretty good because on average you're expecting to win like $1,250 or something like that, right? Most people probably wouldn't take it. It's just because this negative thing is really big, right? The pain from losing $1,000 is worse than the happiness from winning $1,000. Okay, so how do we explain this? Well, in economics, here's the way that we explain this, because we're math people and we make graphs of everything. So this is what we're going to do. We're going to graph this thing called the utility function. Okay, so first, what the heck is utility? Utility is, for lack of a better term, it's our happiness, how happy we are, right? You can think about it like, utility generally means like usefulness or something like that. It's like, what's the use of something to me? How happy does it make me, right? And so right now I'm going to draw this graph where we talk about how happy or how much utility we get from our wealth, our money, okay? So I put it on a graph that looks like this. Remember, anytime you approach a blank graph, you don't look at the thing in the middle. Every time you approach a graph, you don't look at the middle. You pretend it's blank. And you look at the things on the axes. So I've got utility, or happiness, and I've got wealth, or money down here. Okay? I could, if I wanted to, and people in economics do this all the time, they put anything they want, like education down here, and they draw a graph of how happy you are when you get education, or how happy you are when you eat tacos from Del Taco, or whatever it is, right? Right now, I'm going to talk about wealth. And it ends up that our happiness looks like this, right? Now, what does that mean? Okay? This means that as I get more and more wealth, yes, my happiness goes up, but look, it starts slowing down. You see how that starts slowing down? So as I get lots of wealth, even if I get a lot more wealth, it barely adds to my happiness, okay? Now, this is how we explain that most people's utility functions look. All right? This is, as economists, our beliefs Now, people's might be more curved or less curved, or like maybe down here or maybe up here. They might be in different spots, right? The point that I'm trying to highlight to you is this shape, okay? Right? We call this concave down in math class, right? And so let's say I have this much wealth right now, and that gives me this level of happiness, all right? But now let's do the gamble, right? Oh, before we do the gamble, as I get more wealth, my happiness goes up but slower. That's called diminishing marginal utility, right? Marginal utility means how much extra happiness do I get? How much extra utility do I get? That's what marginal means. And diminishing means each time I get an extra dollar, it makes me less happy than the one before it did, right? Each time I get an extra dollar, it makes me less happy than the one before me did, okay? So the more wealth a person has, the less extra utility or extra happiness you get from every additional dollar. That's what this graph is showing, all right? I took this idea and I put it into a graph, and I get this. Okay, that's all that graph is showing me, just the shape. Now, if you find this hard to believe, imagine the following scenario. A poor guy walks along. Oh, I'll let you write this down first, and then I'll give you the scenario. Okay, imagine this. Some poor guy's walking along the sidewalk, and he finds $20. Bill Gates is walking along the sidewalk, and he finds $20. Which guy is happier?
The poor guy.
The poor guy. $20 is a big deal. To Bill Gates, you know that they've done studies that show it's actually not even worth Bill Gates' time to bend over and pick up the $20. It's not even worth Bill Gates' time to reach over and pick up $100. The amount of money he makes in whatever the 5 seconds it would take from when he's running his businesses or whatever is more than the $100 he would get from bending over. Isn't that crazy? Okay, but anyways, that's not really here nor there. The point that I'm trying to make with that example is that as you get a high amount of wealth, the extra happiness that you get, the extra utility you get from one extra dollar is going down. Okay? And that's how I show it, is with this curved utility function. Okay? So now let's go ahead and use this shape of our utility function, which I think is a good approximation for people, to try to explain what happens in that coin toss game, right? The coin toss game. Let's say you lose $1,000. This is the amount of money you're at right now. And you lose $1,000. Okay? Well, this is what your happiness was from your original amount of money, and you lose $1,000. This is your amount of happiness now. This is the amount of utility loss or happiness loss from losing $1,000. Everybody understand how that went? But let's say you win $1,000, okay? So you win $1,000, you get here. How much happiness is that going to give you? It's going to give you this level. How much additional happiness or additional utility do you get from winning 1,000? It's only that much. It's way smaller. Do you see? The happiness you get from winning money is less than the happiness that you get from losing the money. Okay? So when our utility function has this property of diminishing marginal utility, okay, so when our utility function has this property of the curvature like this, when I lose wealth, there's a huge loss in my happiness. But when I gain wealth, there's not a big of a gain in my happiness. Does everybody see that? Okay. So the idea here is that the loss in happiness that I might get from the gamble is worse than the gain in happiness that I might get from the gamble. Okay? So let me show you something very interesting. So you look at this person, and if they were to take this gamble, The expected value is this amount right here. They expect to get this amount, right? Because it's 50-50. So the expected is right in the middle, right? But once they play the game, they could either be up here or they could be right here, depending upon they win or lose, right? So what's the average or the halfway point? Because remember, they could get this 50% or this with 50%. The halfway point's down here. Everybody see that? Okay. So the happiness from playing the gamble, the amount of happiness that they're going to expect to get is right here. Everybody see that? So if I take this over to the utility function and put this amount of money here, you'll notice this is less than the amount of money that they had to start with. Does everybody see that? So there's actually some sort of a difference here. If they can imagine a world with no risk at all, they would be here, right? Because that's no risk. They don't have to play any gambles. They get that level of happiness, right? But in a world with risk, right, they expect to get this level of happiness, which is pretty low, and that's paid, and that's kind of like as if they had this much money, okay? So the difference between this kind of bummer state of the world where they have to take the risk and this nice state of the world where they don't have to take the risk, that's called a risk premium, right? I'm willing to pay, and any of these people are willing to pay however much money this is, because remember, this is on the wealth axis, so this is actually dollars, right? Let's say the difference here is $50, right? I'm willing to pay up to $50 so I don't have to be in the world where I have to take the risky gambles. I'm willing to pay up to $50 just to have a nice life with no risk, right? And this has nothing to do with present value or inflation or anything like that. This has to do with risk. I'm willing to pay up to $50 to not have to take that risky thing because I don't really like this loss. All right? Well, guess what? What is that called when you pay some amount of money so you don't have to take a risk? Insurance, right? This is why people can buy insurance, right? I always imagine that in the 1800s, when insurance started becoming popular, that must have been a pretty hard sell at the beginning. To us, now it makes sense, right? We just, oh yeah, insurance, it makes sense. I mean, we're even required to have car insurance. The theory of economics tells us that yes, there is some amount of money called a risk premium that people are willing to pay to not have to take the gamble, right? But that must have been a hard sell. Hi, I know you guys have never heard of this, but if you all pay me money right now, I'll just go ahead and make sure you don't have any risk. Like, how do you sell that? I don't really know, all right? It must have been a hard sell at the beginning. Then they kind of finally got the ball rolling. Now it's more common. But I think in the beginning it must have been really hard to get the ball rolling. Okay, so we call that insurance, all right? When you pay a little bit of money to not have to take a risk, we call it insurance. So basically, here's how insurance works. There's all kinds of insurance, but here's basically what happens. The person facing the risk pays a fee. Remember, I'm willing to pay up to whatever this risk premium is. So if you charge me anything less than this, I'm happy. I'll take it. I'll buy insurance, right? To the insurance company. And the insurance company says, whoa, if you lose $1,000, you don't have to pay it. We'll pay it for you, right? So you don't have. If you win $1,000, you don't get to keep it either. We get to keep that, right? The insurance company sucks it up, whether it's good or bad. But that's okay, because we don't really like that gamble, right? And it's fair, because nobody in this room, well, maybe one, nobody in this room really wanted to play that flip game with where you win 1,000 or lose 1,000. Nobody really wanted to play that. So if the company says, oh, if it comes down to it, I'll play that game for you, right? You won't have to worry about it. You're like, oh, that's fair. I'll actually even pay to be able to participate in that. And that's basically what insurance does, okay? So the idea here is that it allows everybody's risks to be pooled together, right? And then some people are going to lose the gamble, but some people are going to win the gamble. So they all cancel each other out, right? And you don't have to deal with it, okay? So it actually makes risk-averse people even happier. And so here's an idea. Let's think about fire insurance for your house, right? Well, let's say that only 1 in 10,000 people's houses burns down. Let's say that it's probably pretty low, right? Which is great if you're the guy whose house doesn't get burned down, but really bad if you're the guy whose house gets burned down, right? I don't want to take that risk. So what I do is I get 10,000 people all together, and we're all going to pay just a little tiny bit of money, right? One 10,000th the cost of a house, and we'll just put it in the bank account. And then whoever's house burns down, we'll just take it and pay for the house. And then nobody ever has to have the risk of their house burning down. Because even if your house does burn down, you get paid for your house, and it's totally fine, right? That's the idea of insurance. We pool everybody's risk together, okay? But before I do that, I want to point out something. Think about, you guys need to make a good insurance company for people whose houses might burn down. Okay, you're going to make fire insurance. Let me ask you this. You have to get 10,000 people in your insurance company, right? Do you want to get 10,000 people that are all in the same neighborhood?
No.
No. Why is that a really bad idea? Because if the fire comes, it's going to burn down everybody's house. And then you're not going to have enough money to pay for it, right? What you want to do is get 10,000 houses that are in 10,000 different places in America, right? And hopefully in nice places where it rains a lot too, right? If you're really smart, okay? So the key is you have to diversify the items in the insurance, right? They can't all be the same. Because if they're all the same, then the fire's going to come through and it's going to burn everybody's house. That would be crazy, all right? You can't protect against that, right? So you have to get individuals that are very different. Okay, so that's one of the issues when it comes to insurance. Now, there's actually 2 big problems that we face in insurance. And these 2 problems actually happen everywhere in economics, not just in insurance. Okay, but I'm going to explain them to you in the insurance market. And then just remember them. You need to know them for the rest of your econ careers, okay? The first one, and they're weird names, so just deal with the names. Memorize the names and memorize what they mean. Adverse selection, okay? So the first problem is that a high-risk person really wants the insurance. So they're for sure going to buy it, right? What about a low-risk person? They're probably not ever going to need the insurance. So will they buy it? No. So if I just let anyone buy fire insurance who wants to, the only people who are going to buy it are the people whose houses are like in San Diego that they're about to get burnt, right? Well, that's a big problem because then the risk is going to be really, really high because then if a fire comes through, then all of the people in my insurance company's houses will all burn down together. And then I won't have enough money to pay, right? And the insurance company will go out of business. That's called adverse selection. It's when only the high-risk people enter the insurance market in the first place, okay? So in our fire insurance example, right, we need people whose houses are probably never going to burn down. Basically what we want is only people whose houses are never going to burn down, right, in order for the insurance to work. But if we get too many of the high-risk people in, then there's too many of the houses in my insurance company are going to burn down, right? So one of the ways to deal with this problem is by making insurance mandatory, is by forcing everybody to buy it, right? In California, well, in the whole United States, we've been doing this a long time with car insurance, right? If I let anyone who just wanted to buy car insurance, who's the only people that are going to buy car insurance? The people who crash all the time, right? Exactly. That's not good. People who are good drivers that never crash, they're not going to want to buy insurance. They're like, I don't need insurance, right? And so the only people who buy insurance are the people who crash all the time. Well, then everybody's going to crash. Then that's not insurance anymore because then the entire insurance company is going to have to pay for all of those people, and they're going to have to pay for basically the full amount of their crash, which is not insurance. What you need to do in an insurance company is get a bunch of people who will never crash and like one person who will crash, right? And then that's insurance, right? Okay, so that's why in California, in all of America, we have mandatory automobile insurance, right? Everybody pays automobile insurance to pay for those couple of people out there who crashes, right? Anything else has happened recently that also has to do with this, you guys know? Obamacare, right? What have we been doing? We're forcing everybody to buy health insurance. Why? Because we know that insurance actually makes people better off, but we know that the only people who want to buy insurance are sick people. All of the healthy young, there's 40 million, before Obamacare went into effect, 40 million young, healthy people, me included, were not buying insurance. Why? I don't go to the doctor. If I buy insurance, it's going to be a waste of my money, right? But the insurance companies need people like me, and probably all of us in this room, who don't go to the doctor that much, right? They need us to pay our fee, our premium, so that they can pay for the couple of sick people in there, right? And so that is how required insurance actually improves society, right? Because we know that each individual person is actually better off with insurance. No matter how small of a chance that you'll actually get the loss, the bad outcome of the world, right? The bad part of the gamble and get sick and get cancer or whatever, no matter how small that loss is, you're still better off with insurance. But insurance companies will go out of business if they only have sick people as their people, right? Okay, so that's the first problem, adverse selection. The biggest way to overcome that is just make everybody buy the insurance, require it. Or you can just try to do a really good job beforehand trying to like ask them questionnaires. You guys ever apply for health insurance and they ask you if you smoke or if you do this or do that? That's why they're trying to figure out, make sure you're a healthy person. They only want to let healthy people into their insurance company.
Is life insurance not as much because it's guaranteed?
Well, is life insurance different because everyone is guaranteed to die? Yeah, except for not all life insurances like go until you die. A lot of life insurances are just like 15-year terms or 20-year terms. And if you don't die inside that 20 years, then they get to keep the money in, right? So it's a little bit different. Okay, so that's one problem with insurance, right? Everybody see how that problem works? There's another problem which is just as bad. This problem is before you actually get insurance, adverse selection, before you actually get insurance. But there's a problem once you get insurance. Anybody imagine what that is? It's called moral hazard. You get really careless once you have insurance, right? If you have insurance that's going to protect your car, you might just kind of start playing bumper cars with your car, right? Okay? That's called moral hazard. These are weird names. Just memorize them and deal with it. I get a little more risky when I have insurance because I know it doesn't matter because someone else is going to pay for it. Okay? And so this is really hard to deal with. Really hard to deal with. That's why they send insurance adjusters out to like investigate your crashed car to make sure it wasn't your fault. Or else they're not going to cover you, right? Or they'll drop you, or they'll charge you higher rates or something, right? They try to protect against moral hazard. Okay? So insurance companies cannot fully guard against these problems, so they have to pay slightly more than what you would expect in order just to take away the risk. They would have to pay more. I mean, they charge more. We pay more in premiums. Okay. All right. And so because they pay a little, they charge more, the low-risk people are like, I'm not going to buy this because I never need this insurance. They drop out of the insurance market. It's bad for everybody. The high-risk people don't have anybody to share their costs with. The low-risk people don't get the benefit of having insurance, right? So we really want to try to, if possible, force everybody to buy insurance in a certain marketplace, right? All right. So here's some 3 scenarios. You tell me whether it's adverse selection or moral hazard. Okay, we got, after buying fire insurance, this guy starts smoking in his bed. This girl is got a genetic tooth defect, and this girl is careless with her Corvette, or her convertible Corvette. Okay, you figure out if those adverse selection or moral hazard. These are kind of silly examples, but they show you the sort of problems that insurance has. Okay, what did you get for A?
It's moral hazard.
Moral hazard. This guy's super risky, right? What did you get for B?
Adverse selection.
She knows she's going to have tooth problems, probably. Both her parents had it, right? So she buys it. What about this girl with her Corvette? She didn't put the top up.
Moral hazard.
Moral hazard. Very good. Okay. So those are just some problems with insurance. I'm going to talk about now, switch gears a little bit, and we're going to measure the risk that people undergo when they buy a stock or a bond or when they contribute money to the investors. How do we measure risk? Well, I'm not going to go into a bunch of statistics. You'll get it later when you take business statistics. But there's this thing called the standard deviation. So let's say I expect a stock to pay me back 4% per year, but it has a standard deviation of 10%. That means that at any year, on average, it could be anywhere from 4 plus 10 to 4 minus 10. Right? It could be anywhere from 14 to negative 6. That's what the standard deviation means. So the bigger the standard deviation, that means it's really risky. A small standard deviation means it's not risky. Okay? So if you can imagine, if you had two stocks, one promise or you thought was going to pay 4%, but really on average it could be anywhere from 3 to 5%, but on average it's 4%. You could buy another one that on average it was from 8 to 0, right? Which one are you going to buy? Well, most people are going to get this one, right? Some people might pick this one. This would be those risk-loving people, right? You can get anywhere from 0 to 8%. You still are imagining on average to get 4%. Just like this guy, he goes from 3 to 5%. On average, you get 4%. But you might get 1% or 0% over here, which you won't get here. Higher standard deviation, bigger standard deviation, it's more risky. Okay? There you go. The higher the standard deviation, the greater the risk, the more risky. Okay? So, how do I reduce that risk? Well, it's the same way that I reduce risk with my fire insurance example. What do? Get a bunch of different houses from a bunch of different places of the country that are different. The same thing when I'm buying stocks. I need to do this thing called diversification, or buying a bunch of different kinds of stocks, right? So what you do is instead of putting all your, quote, eggs in one basket, you guys have heard that saying, right? It means putting all of your money in one stock, which has got a big risk. You put a bunch of your money in a bunch of risky stocks, and then some of them will do good and some of them will do bad, and on average, your risk will be lower. Okay? So when you take a bunch of stocks and you buy them all, that's called a portfolio. This is just the terminology that they use in finance. All right? When you have a portfolio, you just take a bunch of stocks and you buy them and you hold them. It's called a portfolio. Now, if you have a diversified portfolio, right, it's going to be less risky, meaning a bunch of stocks that are not related, right? If you put all your money in Microsoft and Microsoft goes out of business, well, then you're stuck. All your money's gone, right? But if you buy a bunch of different companies, then the likelihood of all those companies going out of business is really low, right? We hope. Right. But so some people still make this problem. They say, oh, I have a diversified portfolio. I own Apple, and I own Samsung, and I own Lexus, or not Lexus, the people who make the Google phone, Nexus. I'm trying to name a bunch of cell phone makers, right? They have a bunch of cell phone makers. Is that diversified at all? Not really, right? People are like, I got a bunch of different companies. No, you don't. If the cell phone market goes down, all of those companies together are going to go out of business, right? You're not diversified. You need, sure, Apple that makes cell phones, and then you need, I don't know, maybe an oil stock, British Petroleum. And then you need, I don't know, some firm that makes vehicles, yeah. And then you need something that grows corn in Iowa or something, right? You need very different things, right? So when you have these one or two stocks that go up or down, that you're going to, you're not going to affect your whole entire portfolio. Some of your assets will get the high returns, others will get the low returns. But on average, they average out, so you get some middle value that's not so risky. Go to the next slide. So, diversification, if it's done properly, it will protect against firm-specific risk. We also call that, you'll hear this often, idiosyncratic risk. All right? So it protects against firm-specific risk, which affects only one company or maybe one industry, maybe all the cell phone companies, right? If all the cell phone companies go down together, right? Now, here's another error that sometimes people make. Even when they do have very diversified stocks, right, and they did it well, they got a bunch of different types of stocks, they think there's no risk. But that's not true. There is this general risk that's called market risk, meaning it's possible the whole stock market goes down together, right? It's possible. So whatever the risk of the whole stock market going down together is, that risk cannot be removed by diversification. Only this idiosyncratic risk can be removed through diversification. Both of these things occurred during the housing bubble. All right? First of all, when people were making loans, the banks would make the loans and then they would just sell them to investors, to people, to savers, to use the word properly, right? And the savers, they thought they were getting diversified bundles of loans, but the fact of the matter is they were all house loans. They were all home loans. So it's very possible the housing industry would go down together, right? They were not actually protected. Does that make sense? Really, if you want to buy something diversified, you buy something with stocks like a real estate investment trust that has loans for homes, and you need to buy something else for oil and something else for cars, just like we were talking about, right? And then the other side, they thought that even on the actual diversified portfolios, they had zero risk, but they didn't think about the idea of market risk, the whole entire stock market falling altogether, which it also did, right? So these people, some of the people who were saving and trying to diversify their stocks were actually making both of those mistakes. Okay? So let's imagine that you have a portfolio and you're buying stocks in it. And let's say you just buy one stock. Okay? Well, what's the standard deviation? Meaning how risky is it? If you just have one stock, it's really risky, right? Because that company might fail or it might be going, right? But if you have 2 or 3 or 4 or 5 stocks, the risk is falling. You see this? So the more stocks you put in your portfolio, the more the risk falls. And it kind of seems to level off at about 20%. So no matter how many more different, remember this is different stocks from like different industries, right? In order to diversify. But why does it settle at 20% and not go below that? Who can tell me? Because of the market risk, right? There's still going to be market risk. So this is saying there's a 20% chance that the whole market is going to go down together. Okay? That's this thing called market risk. Okay? That's the market risk. All right, so there's a trade-off between the riskiness and the return on the asset. In general, if you pick a riskier stock like this one right here, you have the potential to get a higher return, right? Why do people accept higher risk? We all know people don't like risk. Why do people accept high risk? Because there's a possibility of making more return, right? So look at this. Over the past 200 years, pretty much since the main stock exchanges have existed, average real return on stocks, meaning once you adjust for inflation, right? So this is really good. 8% over the past 200 years. If you exclude the current financial downturn, over the past 30 years, stocks have made 10%. That's really, really high. Remember with compounding how 10% is like a really big deal, right? But look, on really safe investments like government bonds, right? There's really no risk by putting your money in the United States government, or so they say, right? That's what the bond raters say. You only get 3%, right? So there's no risk. This 3% only includes inflation and the time preference for money. This 8% includes inflation, time preference for money, and risk, right? That's why they're way higher, okay? So you can take your portfolio and you can divide it between two different classes of assets. Remember, assets are stocks or bonds, two different types of assets. You can either have risky stocks, right? And so risky stocks on average will make you 8%, but they have a 20% standard deviation, right? So they might make you 8%, but they also might make you 28%. They also might make you negative whatever that is, 12%, right? So like that's a big deal, right? So you have this risky stocks, or you can do you buy United States government bonds, right? So you'll make 3%, and is there any risk in buying United States government bonds? No, you'll get your money back for sure, right? So how much of each should you buy in your portfolio? Well, it depends, right? It depends on how much you have of each one in your portfolio. That depends upon how much you make. So if I were to graph, I put something that looks like this. This is from the textbook, right? If I have no stocks, so all of the government bonds, right? I make 3% and I have zero risk. That's nice, right? But if I add some stocks, I'm maybe making more like 5%, but I have a little more risk, right? As I keep adding more and more stocks in my portfolio, if I get to all stocks, well, then I'm at 8% return. That's great, but dude is risky, 20%, right? It could be anywhere plus or minus 20. That's what this thing means. So there's always this upward sloping line between how much you're going to make and the risk of your portfolio. Okay, so there's always that trade-off. So if I put more stocks, it makes the return go up, but it also makes the risk go up. Okay. So this just really depends. If you are a young investor, you might be okay with a lot of risk because, hey, if I lose all my money, that's fine. I still have many more years to work. Right? If you're a retiree that doesn't have any other income and you lose everything, that could be a really big deal. Right? So the types of assets that you hold in your portfolio depends on your investing goals, right? On your savings goals. Okay. So this final thing we're going to talk about is how to determine the price of a stock, and then we'll be pretty much done. So we're going to talk about valuing an asset, or how to determine the price of a stock or bond. And this is actually, I think, one of the most important and interesting pieces of this chapter, because it teaches you a little bit about how to look at the stock market, right? Because stocks their prices are going up and down all the time, and some people want to jump in and buy them, and let's talk about it. So what we want to do is when we want to buy a company stock, I look at the price of the stock, or the cost, right? And I compare the cost to what the benefit that I'm going to get from the stock. Now this is like no duh, right? But now I have to define which is which, right? So the cost of the stock is how much it's listed for on the stock exchange. And the benefit of the stock is how much I get out of it. Okay? So if the share price, the cost, this is the cost, right, is greater than what I get out of it, the value to me, the stock is called, it's overvalued. Meaning the price is too high. It's not really worth that much, right? If the price is less than the value, right, meaning the cost is less than the benefit to you, the stock is undervalued and you should buy this stock, right? It's cheap. If the price is equal to the value, the stock is fair or fair valued. Okay? Now, on average, I want to let you know, and I'll talk about this a little bit more in the future, this is what's always happening. If this or this happens, in a split second, some smarter, better investor is going to take care of this and it's going to fix it, you know? If a stock is undervalued, somebody's going to buy 100,000 shares of it and boop, it's going to bring the cost back up to the fair value. Almost instantaneously, all right? So the general idea is in the stock market, this is always true. And if this happens, it's only for a split second, okay? Now, not all economists agree with what I just said, just so you know. A lot of economists think that this happens, like when the stock market bubble went up, like this happened for a long time. And, you know, maybe it did. Okay, so what I want you guys to do, come on in. What I want you guys to do is calculate the value of a stock. Because, look, it's pretty easy to calculate the cost of a stock. You just go look it up on the internet, right? On ShareBuilder or E-Trade or Scottrade or whatever you want to use. This is a little harder to calculate the value to you of owning that stock. Okay? So here's what we're going to do. We're going to imagine you buy a share of AT&T. What's the value to you of AT&T? Do you guys remember the two ways that you make money off of stocks? Okay, so there's either you can sell it at a later date, right? You can sell the asset at a later date. Then there's this other thing called dividends, right? The company pays a chunk of its profits to you in the form of dividends. Okay, so you have two options. And so here's the first thing. You'll be able to sell it for $30 in 3 years. And also, you'll get a $1 dividend at the end of each of those 3 years. So what I want you to do is, these are all future dollars, right? These are all future dollars. What I need you to do is go reach out there and grab those future dollars, turn them into today's dollars. You know how to do that. I just taught you. Okay? And then compare it to the share of the price of the stock today. Okay? And so what are you going to need to know to be able to grab those dollars and bring it back is the interest rate. Okay? So what I want you to know is, what I want you to figure out is get all these dollar values in the future, bring them back into today's dollar values, and figure out how much that is. Okay, so what did you guys get for the value to you of the AT&T share? Remember, you had to take those dollar values from the future and pull them into today's values. So how much you will receive? $1 in 1 year, which feels like only 91 cents, right? Present value equals the future value divided by 1 plus r to the first power, right, to the n power, to the number of years, so that's 1, right? When I get the dollar at the end of year 2, it doesn't feel like $1 to me. It feels like future value divided by 1 plus r to the second power. It feels like only 83 cents to me, right? When I get the dollar at the end of the third year, okay, it doesn't feel like $1 to me. It only feels like 75 cents to me. And then finally, when I sell this share in the stock in $30 in 3 years in the future, that feels like $30 over 1 plus r to the third power, $22.54 to me, right? So in total, those are all the benefits that I get. It's in the future. But when I take it back into today's time, remember in economics, I always have to take future values or past values, either one, and bring them into today's time because I always make decisions right now today. Okay? It equals $25.03. That's the value to me today of owning AT&T. So guess what? I go look up how much AT&T share price is, and if it's less than $25.03, I should buy it. If it's more than $25.03, it's overvalued and I should not buy it. Does that make sense? So clearly, I mean, there's a lot of I way oversimplified this. We don't really know how much dividends we're going to get. We don't really know how much the share is going to be worth in the future. All right? It's very difficult. Right? The value of a share to you today is the present value of the dividends that the share will give you over that time, and then also plus the present value of the price you'll get when you sell it. Okay? But you have to move those into today's values. All right? Clearly, I made this too simple. You don't really know what the future dividends or the future share price will be. I understand that. I was just kind of showing you the theoretical idea here. So when you see finance economists use what's called fundamental analysis or pricing on the fundamentals or analyzing the fundamentals, it means they did this. It's really not that difficult, this part to understand. The difficult part to understand is how they found out the dividend price and how they found out the estimated stock price in the future. Okay? And so this is called fundamentals. Most people think that if you stick to fundamental analysis, you're not going to be paying too much for stock. It'll be hard to lose money on average over the long haul with fundamental analysis. Right? Okay, let me ask you just to tell me what you think. So, you have an account with Merrill Lynch, right? Your investment advisor, your broker calls you. They're like, oh, I have this hot stock tip. You really need to buy. This happens all the time, by the way. When you guys start getting extra money and you start investing, people call you, oh my goodness, this EEG Co. or they're gonna be some name of some company. It's a really hot stock. I got only 20 shares available. Do you want in? Let me know. You know, he suggests the company is highly profitable. Should you buy the stock? Who says yes? What do you think? Okay. I mean, this happens all the time, and a lot of people listen to this. A lot of people buy this, right? Who says no? Who didn't vote at all? You have to vote. Who says yes? Yes, people. Okay. Who says no? Okay. All right. So, who says not until you read the prospectus? No. Who says what's a prospectus? Okay. So a prospectus is something that a stock provides to the buyer, the people who are going to buy the stock, telling you all about the company and stuff like that, to try to help you out understand the fundamentals, right? And then there's not until you read the prospectuses. Okay, so there's an underlying idea here. The idea is, and I brought this up a couple of times, no one person can beat the stock market. This guy's trying to tell you can beat the stock market, right? The idea here, this is a hypothesis. No one person can beat the stock market. And so, I mean, what I'm going to tell you kind of seems to think like no is the right answer. There is no right actual answer to that question, right? There are plenty of people who made a lot of money in the stock market listening to their brokers, okay? All right, but there's this hypothesis. It's called the efficient markets hypothesis. Efficient markets hypothesis, all right? And this basically is just about pricing, asset valuation. It's the theory that the price of the asset, the price of the stock, already everything that can be known that's legal, that's not insider information, all public information, boom, is already available in the price of the share, right? So the second any knowledge becomes available, the second any hot tip becomes available, the stock price either goes up or down automatically before you can even get to it, is basically the idea. It's generally accepted, especially for just individual casual investors like me and you, right? And the reason is because the idea here is the second any new information comes out, some bigger, better, quicker investor, more sophisticated investor is going to go in there and buy the stock, and the price is going to go up. And by the time you get to it, the price has already risen, and it's not going to be, you're not going to actually make any money, right? So for the average investor who does not own a huge brokerage firm or does not manage a huge mutual fund, this is generally accepted to be true. Yeah. And because of the big guys already moving in there and getting the stocks before you can. Okay? So what does this mean? There's three things. One is that the stock market prices are informationally efficient, meaning the stock price is already adjusted instantaneously to any new information. Stock prices follow a random walk, meaning they go up and down randomly. And this is the big one. It's impossible to systematically beat the market. You might be able to do it once or twice. You might be able to be the first guy in there. You might actually be able to do that on one time, right? But you as the average investor, or I as the average investor, cannot systematically do it, because by the time we get in, some big fund manager or mutual fund manager or stockbroker is going to already run in there and grab the shares. Yes. So this is talking about trying to get in on a hot tip before other people does. That's what the efficient markets hypothesis is talking about. It's not saying you can't make money in the stock market. Remember, on average, 10% is how much the stock market has been paying out in the last 30 years. You can make 10%. The efficient market hypothesis is saying you can't make more than 10%, right? Or you probably won't make less than 10% either. That's a good thing, right? You'll get the average return. Okay? You'll get the average return. So, real quick, index funds versus managed funds. So there's these things you can put your money in called index funds. They're very simple. It just buys, let's say the Dow Jones Industrial Average, right, is made up of 30 firms. It just buys a little bit of those 30. So as the stock market goes up, the index fund goes up. It matches the stock market exactly. That's what an index fund is, right? And then there's these things called managed funds, right, where the guys are trying to move their money to get the hot stock tips and get all the best dollars, right? Now, it might make sense to you, and a lot of people pay a lot of extra money for some brilliant investor to move their money around. A lot of people pay extra money for this. This doesn't take any extra money. It just buys a little tiny bit of all of the stocks, and then it exactly matches the stock market, right? If you buy a little tiny bit of every stock, well, then your portfolio is going to exactly be the same as the stock market, right? So if the stock market goes up, yours is going to exactly go up. But if you are in an actively managed mutual fund where the guy's trying to move your money around to all the hot stock tips, your return might be more or less than the average of the stock market, okay? We're actually going to look at that right now, actually. So clearly, if you have an actively managed fund, you have to pay some hotshot investor. That's really expensive. It takes up a lot of your money, right? The efficient markets hypothesis, what does the efficient markets hypothesis say? Will the stock market, the hotshot investor, be able to beat the stock market? No, right? That's what it says on average. It might be able to 1 or 2 years. And that's how people get drawn into these, I think, maybe, I don't know, mutual funds that are managed by some hotshot investor guy. It's because 1 or 2 years they'll have a good year, right? And so people get drawn into it. All right, so I just want to show you, if you just were to buy a little bit S&P 500, that's one measure of the stock market. If you were just to buy a little tiny bit of all 500 of these, that's called an index fund, right? From 2001 to 2006, you would have made 6.2% per year. Okay? And the expense is 0.351. This is just how much expenses it has per dollar, right? Or per $100, I think. If you were to have a managed large cap fund, meaning some hotshot investor is investing in large companies, right? That's what large cap means. Large companies, you would have only made 5.9% per year. That's what the efficient markets hypothesis would tell us over an extended period of time, right? In any 1 year, it's very possible that these guys outperform these guys, but over time, right? And then notice this. There's all big expenses, right? Because you have to pay these hotshot investors. What about the medium-sized stocks, right? So you were to just buy these 400, a little tiny bit of 400 medium-sized, that's called an index fund, right? So you're going to match the stock market exactly. You would have made 10% interest, right? 10% on your thing. If you were to use a managed middle size, you would have gotten 8.1%, right, on the average of all of them. Okay, much more expensive also. And then finally, if you were to have of all of the 600 small ones, small companies, you would have made 12.5%. First of all, wait a sec, notice that the return is getting higher and higher as you get smaller and smaller. These are more risky, right? These are more risky, it's true. That's why you get a higher return. But when you spread it out to 600 individually small risky firms, the overall risk starts to go down a lot, right? And you still get to take advantage of the high growth or the high returns of small risky companies. And even if you were managed, right, it's actually lower. This is telling you that this is a little bit of evidence about the efficient markets hypothesis. No person can beat the stock market systematically, right? Because when the new hot tip comes in, somebody jumps on it before you get to it. And then when a new hot tips come in, somebody else jumps on it than the first guy, not the guy who did it originally, right? So this is showing you that just putting your money just into what's called an index fund, which just matches this boring, it's boring, right? Just matches the stock market exactly. There's no flair, there's no panache, there's no like, oh my goodness, I got the next Google, or I've got the next Apple stock, or I got the next Berkshire Hathaway, or anything like that, right? It's just boring. But over the long haul, you're going to make 12.5%. With compounding, it's a lot, right?
So when you invest in index fund, you just, like certain companies run it, and you actually literally invest in all 500?
Yep. You literally invest in all 500. By an index fund, you literally invest a little tiny bit, right? Because it gets divided into 500 firms. Yeah.
So is it kind of run like a mutual fund, but they don't?
No, it's not run like a mutual fund at all, because these guys are constantly moving your money from one firm to another, to another, to another. This just sticks with whatever you have. There's very little. You don't have to be a genius to operate this, right? And like almost a monkey can do it, right? So you don't have to pay the guys that much to run these. So you don't lose a lot of. This is your expenses, how much you lose to pay. I don't think so. I don't think there's any you can do on your own. I mean, you could theoretically, if you wanted to calculate how and just buy 500, but that would be so expensive because when you go to buy a stock, you have to pay generally a commission on each one you buy, and so you'd have to pay 500 commissions. Whereas this, you just pay one commission. It's not even that big, and it splits it up for you.
So do you think the fund managers of index funds have a pretty chill job?
No, I think fund managers of index funds. Yeah, I don't really know what it looks like, to be honest with you. I know these guys have like the worst jobs in the world. Well, they make super amounts of money, but it's super stressful. And then when the stock market goes down, the guys are jumping out of the windows. It's really, really stressful. Sounds terrible job. I'd never want that job. All right. Okay. So finally, sometimes I need to get you guys out of here really soon. Sometimes stock price movements cannot be understood. John Maynard Keynes, one of the most famous economists ever, when someone asks him, why do stock market prices go up and down then if it's not about the fundamentals, he's like, oh, animal spirits, right? In other words, he has no idea why stock markets go up and down. Alan Greenspan, you guys remember this guy? He used to be the chairman of the Fed in the 90s. He's called it irrational exuberance, right? In other words, he got no idea, right? So there's these things when the prices of the assets go up too much called bubbles, and they end up popping. I talked a little bit about it 2 chapters ago when I explained kind of why I think that the housing price bubble popped. Okay. But then again, when people go crazy up or down, maybe it doesn't end up hurting the efficient markets hypothesis after all. It's kind of unknown. Okay. So finally, in conclusion, and then I'll let you guys go, we got the tools, present value and future value, to be able to understand if I want to make an investment or not. Efficient markets hypothesis, you can't beat the stock market. And then we'll talk a little bit about when the prices go up and down later in this course even though it's not 100% understood why.